infrastructure is built, the capital is moving, and now you have a choice. You don't need to believe in Bitcoin. You just need to believe in math. Institutions are now learning that Bitcoin is not just digital gold. It's monetary architecture built for a world of endless mistrust, constant overreach, and oppressive inflation. It has no central issuer, no credit risk, no dilution. You all know all this. Its monetary policy is embedded in the code. Only 21 million will ever be issued, full stop. It clears 24/7. It's borderless, programmable, and it's neutral. And in a multipolar world where sovereigns are questioning the dollar system and seeking neutral reserves, Bitcoin is the first digital asset that offers true and trustless neutrality. It's simple. Bitcoin already trades over $50 billion a day. It settles in real time. It's got full public ledger transparency. I'm preaching to the choir, I know that. But Bitcoin is the only uncorrelated global liquid hard-capped asset that exists.
James Lavish begins with a brutal reality. He clarifies that the financial system is based on the appearance of stability and that central banks are continuously stepping in to keep markets afloat behind the scenes. Whether it be through rate reductions, liquidity injections, or outright bailouts, the system needs constant help to survive because it can no longer operate on its own. Please remember to like this video, subscribe to our channel, and enable post notifications if you have a strong interest in learning about the future of finance and the function of digital assets like Bitcoin. This will ensure that you never miss anything. Thank you, and enjoy the video.
Okay, so what are we looking at here? We're looking at the growth of all the liquidity and the money supply across the world. So why do they have to repress rates in the first place? Why are real yields negative? It's because it doesn't work, the system doesn't work without more liquidity. With debt load so high, the only way out is inflation and money creation. And make no mistake, without more liquidity, the system will simply collapse on itself. And so this chart shows that global money supply growth since 2000. You could see that acceleration in 2008, and then it goes vertical in 2020, where we're adding over 7% per year of money supply, compounded to the global supply. Remember that number. We're going to talk about it in a minute. And here we see in the US how the US Federal Reserve balance sheet grows lockstep with federal debt. That's not an error. That's not a mistake. It's purposeful. That's what we mean by when we say irresponsibility demands liquidity. More debt, more printing. More bailouts, more printing. More fiscal spending, more printing. And if you know that, you also know this: the purchasing power of fiat is structurally designed to decline. All right, let's get into the good stuff about institutional investing. Because the open secret is that the system doesn't just tax your income, it taxes your savings, quietly, relentlessly, systemically. And this ultimately, where it breaks the traditional model. Bonds don't hedge, cash doesn't preserve, the anchor asset becomes a liability. That's the problem for investors, for professional investors, for individual investors, for retail investors. Everybody has the same problem. And the old safe haven playbook is obsolete. You need assets that sit outside of this repression loop. So you have to rethink what safe even means. Which brings us to the obvious question: what do you own when everything denominated in fiat is quietly melting away? That's the question that these portfolio managers have to face every day. All right, so this is the elephant in the room. What do we do? What do we do when there's no safe asset sleeve? So this chart tracks 30 years of institutional portfolio evolution. In 1994, 85% of the capital sat in fixed income. By 2022, that number dropped to 4%. Why? Because safe no longer meant productive. Bonds don't hedge, they don't preserve wealth, they don't meet future liabilities. With negative real yields and suppressed coupons, they become an anchor that drags your returns down, not a risk buffer. And so what happens? You're forced to reach. As an investor, and I've lived this, you're forced to reach into illiquid assets, into private deals, into derivatives and leverage. You build complexity into your portfolios. You increase the duration. You add tracking error, all to chase that same 7% nominal yield across the board. In a world where, remember that number? The global money supply is expanding at the same rate, 7%. Same return target, triple the risk. Zero real return. And complexity and risk are doing all the work. Portfolio managers are simply hamsters on a treadmill, and we all know it's unsustainable. So we arrive at the real question: what do you own when everything inside the system is either inflated, illiquid, or guaranteed to lose value in real terms? And that's where we begin to shift, not into speculation, but into design-fit assets. Assets built for this very problem. And that brings us to the institutional mindset, because it's not easy for institutions. I know it, I've lived it. They can't simply shift their mindset and adopt a new strategy. So Bitcoin maxis like to call these guys dinosaurs. But in reality, institutions are more like massive ocean liners, programmed for a destination. Institutions are now learning that Bitcoin is not just digital gold. It's monetary architecture built for a world of endless mistrust, constant overreach, and oppressive inflation. It has no central issuer, no credit risk, no dilution. You all know all this. Its monetary policy is embedded in the code. Only 21 million will ever be issued, full stop. It clears 24/7. It's borderless, programmable, and it's neutral. And in a multipolar world where sovereigns are questioning the dollar system and seeking neutral reserves, Bitcoin is the first digital asset that offers true and trustless neutrality. It's simple. Bitcoin already trades over $50 billion a day. It settles in real time. It's got full public ledger transparency. I'm preaching to the choir, I know that. But Bitcoin is the only uncorrelated global liquid hard-capped asset that exists. That alone earns it a spot in your portfolio. If you're an institutional investor out there and you're listening to this, it earns a spot because of those things with what's going on in the world. So let's take a peek what happens when you do add it. What we're looking at here is a traditional 60-40 portfolio, the blue line at the bottom, okay? And that's 60% stocks and 40% bonds. Over the past decade, that returned 127%. Not too bad. Annualized rate of 8.5%. Okay, remember what we said the hurdle rate is? 7%. So it's not that great. You only get just over 1.5% of above that neutral rate. So replacing just 1% of the bond portfolio, the bond side of this, it boosts your return to 153% and 9.7% annualized. Okay, better. Adding 5% Bitcoin and taking it out of the bond portfolio to do that doubles your return to 275%. 14.1% annualized, even better. But for the bold, adding 10% of Bitcoin to your portfolio quadruples your return to 495% and a whopping 19.5% annualized rate. Thank you to Bitwise for the model that they've allowed us to use for this.
Perhaps Lavish's strongest argument is his last one. Bitcoin is about protection, not a rebellion. Bitcoin is undergoing a slow but inevitable shift in value. Institutions that used to ridicule it are now investing because they have no other option, not because they suddenly believe in it. Bitcoin is the only viable safety valve remaining in the deteriorating financial system. It doesn't have to take center stage in someone's portfolio. Its price would rise sharply with even a 1% investment from major entities like insurance firms, pension funds, and sovereign wealth funds. Also, a quick reminder, only a small percentage of viewers are subscribed. If you enjoy deep dives into crypto and finance, hit that like button and subscribe. It's free and helps the channel grow. Now let's get back and hear what he has to say.
But if that doesn't convince you, get this, your Sharpe ratio, which is your risk-adjusted return, it goes up with each amount of Bitcoin that you add to your portfolio. And with 10%, you jump over that magic asset allocator number, which is 1.0. If you get over a 1.0 Sharpe ratio, it's easy to defend. So think about that though. 5% Bitcoin allocation, no leverage, no derivatives, doubles your return and significantly improves the risk-adjusted return. Then 10% just kicks it up even further. For any allocator, managing volatility or tracking error, that's not just compelling, it's portfolio engineering. It's not just about betting on Bitcoin now, it's about using it as a convex payoff in a world where traditional assets are delivering linear risk and negative real return. Many of you have seen this chart before. Jesse Myers lays it out clearly. The global investable assets are now over $1 quadrillion. And so, yeah, Bitcoin's the smallest one on there, but gold has been around for thousands of years, and Bitcoin is already a tenth of its size in just 15 years. So some quick math, if Bitcoin captures just 1% of global assets, just 1%, that's a $10 trillion valuation or a 5x from here, without requiring retail FOMO. And the first institution to allocate, well, they're not looking for validation, they're positioning for scale. In a report from Gemini and Glassnode, just this last week, they found that over 30% of Bitcoin's circulating supply is now held by just 260 centralized entities. So this points to directly deepening custodial centralization. What does that mean? It means institutional adoption. And so since early 2015, the Bitcoin held across major institutional and custodial entities have surged to 6.2 million BTC, or an increase of 924%. Look, most institutional managers, they manage multi-generational capital. They don't chase trends, but they all share in the same pressures: duration, mismatch, underperformance, and currency concentration. So this chart, this shows the different reasons that asset allocators are investing in Bitcoin. And of some of the questions they've asked, are you investing it because of duration, or because of speculation, or because of diversification? The blue line is diversification, the black line is speculation. So diversification has emerged as a top reason for investing, overtaking speculation recently. So despite the common belief that speculation is the main driver, it now ranks third or fourth as the most cited reason, often coming in below client demand and diversification. So as fiduciaries, institutions are forced to ask the question, what assets survive if trust in the sovereign money continues to erode? Bitcoin doesn't need a 50% allocation, it just needs 1% from the right players. Because when they allocate, they don't sell, they just rebalance, they normalize it. Bottom line, Bitcoin is the default escape valve, not a rebellion, a refuge. And it'll soon become the pillar asset that portfolios are built around, not the US Treasury, not the 10-year Treasury, it will be Bitcoin. And we're witnessing a quiet institutional adoption. Again, not through hype, but through structure, through process, through the risk models and due diligence and those memos, through all of that. And that's what makes this moment so powerful. Bitcoin isn't being pushed, it's being pulled by the same system that once dismissed it, laughed at it, attacked it.
According to James Lavish, Bitcoin maximalists frequently refer to institutions as dinosaurs, but in reality, they are like enormous ocean liners that take a long time to turn but provide enormous results when they do. Organizations are beginning to understand that Bitcoin is more than simply virtual currency. It is a completely new monetary system designed for a world of oppressive inflation, government overreach, and unending mistrust. There is no dilution, no credit risk, and no central issuer for Bitcoin. With just 21 million coins ever produced, its monetary policy is encoded in code. It is neutral, configurable, borderless, and settles around the clock. Bitcoin provides trustless neutrality in a multipolar world where nations are beginning to doubt their reliance on the US dollar. With complete public ledger transparency, Bitcoin already settles in real time and trades more than $50 billion per day. It is the only hard-capped, worldwide, liquid, and uncorrelated asset now in use. According to Lavish, this alone justifies its inclusion in any institutional portfolio. Lavish concludes by highlighting the promise of Bitcoin in the future. Today, there are more than $1 quadrillion in investable assets worldwide. Even while Bitcoin is still little in comparison to gold, it has increased to a tenth of its size in only 15 years. Bitcoin would be worth $10 trillion, 5 times its current value, if it were to take up only 1% of world assets. This would happen without even requiring FOMO on the part of ordinary investors. Since the old banking system can no longer secure their riches, the first institutions to allocate are positioning themselves early for scale rather than waiting for approval from others. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.